Which one between investing in shares and investing in the equity funds is better? This year, by the way, the shares or equities are performing very well so far, and we are going to expect, or rather, we're going to see crazy figure returns at the end of the year if things remain constant. However, many are really not aware of the difference between investing in shares, also referred to as stocks, and investing in an equity fund. Let's break that down in this video and look at the key differences between the two and which one you should consider or which one you should go for when making an investment decision. Make sure to follow or subscribe because I will be doing more about investing in shares over the coming few days and helping you to win. But first things first, investing in shares or stocks and investing in equity funds such as mutual funds or the ETFs are both ways to participate in the stock market, but they differ in several key aspects. And I'm going to go straight to the point. Number one, with shares, stocks, you directly buy and own individual company stocks like, say, Kengen or Safaricom, Apple, Tesla. So, therefore, you become a direct shareholder of those specific companies. But when it comes to an equity fund, you are investing in a pooled fund that buys a basket of stocks. So in this case, you own units of the fund, but not the underlying stock directly. In other words, when you buy or invest in shares, that is direct ownership, and the other one is indirect ownership. So the fund manager goes to the market on your behalf when you're buying equity funds. Second, when it comes to investing in shares, you are limited to the companies that you can pick. These at times can mean something like higher risk if your investment is concentrated in a few stocks, like you have only Kengen or Safaricom. But on the other hand, when you go for an equity fund, automatically you get to diversify across many stocks, and therefore you reduce company specific risk, like at maybe just that particular one. So selecting your own shares can be good and bad at the same time. So if you make a good choice, you will make a killing. But if things go south, you don't have the security that comes with diversification. Equity funds are generally less volatile compared to investing in shares because risk is spread across multiple stocks. But this can also lead to lower returns because the wins are neutralized by the losses that were selected. So, to help give a balanced kind of return. Next, in terms of cost and fees, investing in shares directly has a lower cost. It's cheaper because all you need is to pay for the broker fees or the commission when buying and selling. But equity funds, on the other hand, ziko na management fees, whether you are making a loss or you're making a profit. And these, calculated over the long term, can amount to a very huge sum of money lost through these particular fees. So, assuming you took a million bob and put it in shares directly, and then you never touched it till 20 years later, you will have saved on massive management fees because you won't be charged any as compared to someone that put money, or rather like went to the shares through a fund manager in an equity fund who has to keep paying the management fee. Inakuwaga ni annual, yeah, inachajiwa every day for all that period of time. So the fourth difference is that shares require research, monitoring, and active decision making. You actually need to understand the market. You need to be keen on the changes that are happening in the market trends. But when it comes to an equity fund, you're completely hands off. Professional managers are the one cooling that stress on your behalf. They're the ones handling the stock selection and the decisions of when to buy and when to sell this or that. You only wait for the results as you go around your businesses. In general, the time and effort that is required for both is like day and night. Now, when it comes to liquidity, shares can be sold instantly during market hours, especially for the large cap stocks, as in zile zina move volumes like in a Safaricom and the likes. But there are times that you might have to wait longer to have your shares bought, especially when their demand is a little bit low ama ziko na issue. But withdrawing from your equity fund, iko easier, only that you need to be cautious of what's your fund value at that particular moment. Because if you cash out when it iko kwa loss, you will end up making a loss, my friend. Lastly, you get to earn dividends on both of these two options. But then there's a difference in the minimum amount that you need to start investing. When you go for shares directly, by yourself, you can actually start with any amount. All you need to do is to pick the stock that you want to buy at the prevailing market rate at that particular point. Like sometimes back when I bought Kengen at 2.4 shillings per share, all you needed was at least 240 bob to buy your first 100 shares. But when it comes to equity funds, there's usually a minimum amount that is allowed to invest in the fund. Hii inasetiwa up na the manager, the fund manager. So some companies have it at about 50k, some 100k, some 20k. So therefore it depends with the fund manager that you settle for, the one that you choose. Then again, you could also have some restrictions to the amount that is allowed to top up as well. Unlike Saziluko directly, you just buy when in vile tu pata do, just buy. So now, which one among these two is better? Which one should you go for? My recommendation: choose shares if you have time, knowledge, and you want some control or all the control over your portfolio. And on the other hand, choose the equity funds if you prefer diversification, passive investment, and low effort. Many investors may they use a mix of both, whereby they pick a few individual stocks while they also keep most of their portfolio in the diversified funds. But just as a point of caution, stocks are very volatile at times. Please don't run until you're going for the returns. If you do not have the backbone strong enough to handle the drops, when they come, invest what you are only willing to lose up to like 50%, so that you don't fall into depression ama become suicidal. I hope this was helpful in helping you understand these two equity fund going to shares directly. So please leave your comments ama question on the comment section below. And above all, thank you so much for watching. I can't wait to see you in the next video where the conversations and the learning continues. My name is Otach.